Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Hi, audience and listeners. This is James Kandasamy from Achieve Wealth through Value-Add Real Estate Investing podcast. Today, I have Ryan Gibson from Spartan Investment Group. Spartan Investment Group focuses a lot on self-storage. They have almost 4,000 units. They have a lot of units in DFW area and a few other states. I think Ryan's going to talk about it in a short while. And they recently started about some development in mobile home parks, which we'll touch about it in a short while. Hey, Ryan, welcome to the show.
Thanks, James, for having me. Fun to get on your show. It's great.
Yeah, absolutely. So why not you tell about yourself and your company, things that I've missed out?
Yeah, so we are based in Golden, Colorado, and we buy and existing and develop self-storage properties. And we do all of our properties and projects through syndications. So we raise capital from private investors, and we go out and buy storages that we can buy and get existing cash flow on, and then we can eventually either expand them or just improve operations to make additional income. We also build self-storage from the ground up, and we do a little bit of RV park investing as well, but storage is the primary focus. So, previously we were land developers and built condos and flipped houses, and focused on storage mostly just because of the recession resistancy, during downtimes. And when we were first looking at the industry, that really is what attracted us to jump into the business, was the kind of how it performed during the last two recessions.
Got it. I did a lot of research of different asset class. I wrote it in my book as well, like how many asset class? 6 asset class for past 15 years. And just on my own, this is not from Marcus and Millichap, or this is not from RD or Costa. Right?
Nice.
I looked at all the asset class and was looking at all the past 15 years report, which there's a report called Integra Realty Resources.
Oh, yeah.
That's the report that all the appraisers, commercial appraisers report to, right? That's the organization. And I was looking at self-storage and multifamily and all that. I was surprising to see that self-storage did do well for the past 15 years, even during the downturns. I know in the beginning, 15 years back, they didn't really allocate a specific asset class for it, but they did talk about it. And in general, I didn't see any downturn, even though there's every other asset class goes up and down. So that's a very interesting. And why do you think is that?
Because it relies on life events, and life events never stop happening. No, seriously. You get divorced. Typically, stuff goes in storage. You renovate your house, stuff goes into storage. In times of good times, stuff goes into storage. In times of bad times, stuff goes into storage. When you get downsized, when you move, when your job relocates, when there's disruption in the market, that triggers self-storage events. And added onto that, businesses use it, because not everybody can park their work truck in their HOA driveway if they're in a covenant-restricted community. And not everybody can have all their utilities and supplies, in their house. And so, simplest way to say it is, for an extra $50 a month, imagine having a whole other room in your house, right? And that's what people have really, that's really been a big driver for demand in self-storage. We like it because, unlike other asset classes, when a customer comes in, we have a lien against all of their stuff. So if they don't pay, we can auction that off for a profit. The revenue loss is much lower for, the potential when a tenant doesn't pay. With COVID and everything, we're not. There was still rental rate increases. We still had high occupancy. We still can host auctions and have people move out if they don't pay. We held back on that on a couple properties and a couple markets, but for the most part, we didn't have the government restrictions that a lot of other asset classes had on that kind of stuff. So
got it. Well, I'm sure the audience is thinking, why not James jumps on self-storage, right? So, but let me tell you why I didn't. And you can always debate this, right? So, one thing I didn't jump on self-storage at that time. Of course, for me, focus is very important.
Absolutely.
Every asset class, there's so much of nuances in this deal. It's not easy, even though self-storage is like 4 walls and there's nothing in it. But
Right.
There's a difficulty in finding the deal, a difficulty in executing the business plan and turnaround and disposition and all that, right? So but I didn't do it because at that time there was not much of non-recourse loan available. I think unless you go really low on the leverage, right? So how is that right now?
You can get non-recourse right now on ground-up construction.
On ground-up construction. Okay, got it. What about on the?
And of course, that would be rare in our industry. Of course, on buying existing self-storage properties, non-recourse is widely available.
Got it. Okay. So now it's available right now. At what leverage level?
Just depends. I think we just tied up a deal that around 70 to 75% non-recourse.
Okay.
Institutional loan. So it just depends. Depends on the lender, depends on the deal, depends on the play.
I had a friend who was like 85 years old. He's a broker, but it's a very healthy guy. And he said he started with multifamily and moved on to storage. And he owns a lot of storage units. And I was calling him and he said, maybe at that time, he said, it's hard to find non-recourse loans, right? The other challenge in storage is, anybody can build a new self-storage development in front of your storage unit, right? It's very easy to build.
Maybe.
Or maybe. Okay. So what
maybe.
are the
So that's you could say that as a general statement that wouldn't apply everywhere. So
okay, got it.
There's a lot of moratoriums on storage. There is a lot of restrictions. Some communities don't have zoning for it. Some cities, quite frankly, would not allow you to use it at all. So, it just depends on where you are. Some jurisdictions, it's, come build it, no problem at all. You just need, it just depends on the market. We have markets where there's like no zoning and we could build whatever we wanted. And there's markets where it's taken us 40 years to get a permit. It really just depends. And then there's some markets where you get your permit and then they slap a moratorium on there and you can't build your storage anymore. That's happened out here in Washington and a few places. So it's, you really got to pay attention. And, and I think really what, the most, if someone was like, what's the one thing that I could take away from talking to a storage operator is the market study. It really comes down to, do you have the demand and is there the supply of people and demand essentially in the market to fill up your property or execute your business plan? Is huge. Someone might say, is storage a good play? And I don't know, make up a city, Austin, Texas. And I will say, well, generally no, it's not. It's actually a terrible market. No offense. But
no worries.
It might be good on one side of the town and catastrophic on the other side. It's a 3-mile business. So it's like whatever's happening around in that immediate micro market is really what it comes down to. So some markets are, generally better. Some markets are generally worse. But at the end of the day, it's right in that 5-10 minute drive time of the property and the market study that makes the difference.
So what is all your details that you're telling me right now, that's why I say there's so much of nuances in any asset class that outsiders may not know, right? It's easy to say, it's easy to build, but, there's so much of market research knowledge that, only the operators who are specialized in it knows about it, right? So, and I really do have a lot of respect for every asset class operators, right? They're definitely people who are really good at that. So let's walk through a deal, right, in self-storage. Not in terms of deal underwriting, but let's look at the demographic of that storage. Let's say you found a land in a city, right? Walk us through what are the steps you would take to say whether this is a good site for a self-storage facility.
Couple of things. First thing I would look at is what's the population. I would drop pin on the facility. We have data and maps that will show us the drive times. And then based on those drive times, we'd get the population within the drive times of the property. And then we would look at saturation levels.
And what is the drive times minutes?
4 minutes. I think we use 8 minutes and 15 minutes. Now, think of it this way. If you're in an urban core, you're not going to drive 15 minutes across town. You're going to drive 8 minutes. So that, there's relevancy to where you are in the market. But what we look at is, we'll look at what are the comparable rent comps to what our subject facility is charging. So, we might be getting $15 a square foot on the average. But it's important to know kind of what type of facilities those are. Are those 3-story glass Class A facilities? Are they, first generation roll up metal buildings? Big difference. Climate controlled, non-climate controlled. Is climate controlled in that market? Is it a hot market, like a warm climate that likes self-storage to be climate controlled, or is it a market that prefers drive up? Or climate control would be overkill and people would be unwilling to pay the extra money for that. So we look at price per square foot. Probably just like multifamily. And then we just look at, for Spartan, we look at the ability to add on to that property. Can we expand it? And what is the existing dirt that's there? What is it? Is it flat gravel? Is there stormwater requirements, setbacks, easements, restrictions? How usable is that land, and how much would it take to get the land pad ready? Because we're developers. I mean, we take properties and develop them into bigger.
What about zoning?
Zoning's important. That's kind of a little bit further down on the checklist, right?
Got it.
The top thing is demand, because you could have, this is zoned for self-storage, and of course everybody knew that, and then everybody built a bunch of storages there, and there's no demand.
But right? Is it easy to change a zoning from, let's say, multifamily to self-storage?
That's a loaded question.
Okay.
And
maybe not multifamily, because I know residential have a lot of high priority, right, in terms of city development. Yeah. Let's say commercial office building, let's say commercial land, right?
So
self-storage.
I mean, it depends, right? So I know you don't like the word "it depends," but it depends. So like if you are looking in a market where we entitled a self-storage project in a city that had no zoning for storage, so everything was a conditional use permit. Everything was a public hearing. The public could come in. The city had to make a recommendation to a hearing examiner, right? Huge process. We've taken residential land and rezoned it into commercial so we could build self-storage.
Oh, really? Okay.
We had to go in front of the Board of County Commissioners. We had to go in front of, there had to be room for public comment. There was opposition, right? But we were successful and got the land entitled. But every jurisdiction is just a little bit different. We've bought properties that are zoned for storage, and we've gotten the entitlements, and they can take anywhere from 2 to 6 months to get it to building permit, depending on how fast you're pushing and assuming no closures in the city and things like that. It just runs the gamut. Like I said, I have colleagues in the industry that have bought property. They got the entitlements. So yeah, you can build storage here. And then the city puts in a moratorium on storage, and now they can't build anything. So they bought this land, they got the entitlements, they've spent all this money. Now they can't even build.
So how do you prevent that kind of things from happening?
You don't.
Because you already bought the land, right? So
yeah, I mean, you could negotiate the contract to close upon building permits, but then you got to find a willing seller, and of course that's always a negotiation, right?
It's too messy at the time, I guess, right?
But yeah, when you develop, I mean, it can be riskier, and it's also there's a potential for a bigger return, but you also introduce a lot more risk. So yeah, I mean, is it easy to do? It can be, and it can be very difficult, and to the point of being impossible. So it really just depends.
So when you guys raise the money from your investors, have you already done that? Let's say for a development project, right? Are you already done that part, or you are still looking at entitlement?
We've really learned our lessons through the years. So we bought a storage property, and when the rezone of the land from so you have kind of a couple of different phases of development when you're doing like the paperwork to get it ready to go vertical. So the last thing you get is your building permit, right? So your building permit there's really not a whole, that's pretty straight down the fairway. That is, meeting building codes, getting your building permit. Not a lot of risk in that. But there's not a lot of risk. But the phase just before that might be your entitlement so that you can actually do what you want to do, or it might even be some type of site plan development where the city has to approve your site plan, but you don't necessarily have your drawings done for the buildings. They've just approved, okay, building here, building here, building here. This is your height. This is your setback. This is how much square footage you're going to deliver. Kind of site plan approval. And then, then you have the zoning that might be before that. And it might already be zoned. That might be your first step. Do I meet the zoning? If I don't, I might have to rezone. That could take years. So, we just kind of look at the project and negotiate with the seller to buy the property. When it's hit a point where we're comfortable with closing on the land, and then we negotiate the purchase and sales agreement as such, and then we do the raise in accordance with how we feel our comfort level to be, because we don't want to raise the money until we know we can do what we want to do.
Got it.
And we've really refined our processes for that over the years to know that, hey, okay, we can close, and we've gotten better at negotiating. Like, how can you expect me to buy this land when I don't even know I can do what I want to do with it, right?
Yeah, correct.
If it's a hot market, make a decision. Either want it or you don't. If it's a property that's been sitting on the market for a year, you can come up with some pretty creative ways to keep the property tied up while you go through that process.
So how many percent of this 4,000 units was developed versus how many was bought from?
25%.
25% was newly developed. Okay. Are you guys more trending towards development rather than buying?
That's a great question. I would probably say we're buying more than we are developing right now.
Okay. Got it.
For no reason other than just we have our development pipeline is full enough. Development is expensive, and development requires a lot of cash, and you don't want too many of them going on at one time. So
got it.
So we have two very large. We have about $22 million right now of development. Actually, no, we probably have about $30 million in development right now, and that's about our comfort level. That's our spend for 2020 for development, and we really don't want to get much past that. We also only develop in the states that we live in, so Washington and Colorado. We don't like to do adding on to a property is not a big deal, but we don't like to do ground up development where we go through the whole process if we live out of state, because inevitably, if you want to get things done, you got to be down at the county, down at the city hall, down at the office all the time. You're going down there all the time. Hey, oh, you want this? Okay, no problem.
Otherwise, it's going to just take forever, right, to get a project done, right? So
and who wants to fly an hour and a half somewhere to drop off a piece of paper and then fly back, right? I mean, it's just not efficient. So we just like to be in town, because I can't tell you how many times I've gone down there to shake the trees and get progress.
Yeah. I've done a small land development beside my apartment. We were converting it. We were combining the adjacent plot of land into the apartment, and that itself was a lot of work already, right?
I bet.
But the city was supportive, and it went through well. But just the amount of paperwork, the amount of bureaucratic process that you have to go through, right? So.
Absolutely. Yeah.
What about demographic? I mean, we talked about demographic. How do you say that this particular submarket is good demographic for a good self-storage business?
We like at least 1% growth. We like to see and trending growth. We like to see 50,000 income. We like to see saturation levels.
Okay.
Like a 7 square foot per utilization for storage.
How do you get that data? 7 square foot per utilization.
We have Radius Plus, and we use a couple of different programs. Radius is one other program that we use.
So Radius Plus is a software for self-storage investors. Okay, for them to see the demand, I guess, right?
If you gave me an address, I could tell you, within 20 minutes, I could tell you what's the drive time around it. I could tell you the demographics. I could tell you the demand. I could tell you all the permits in the pipeline. So that's another thing. And what exists was great, but I can tell you everybody who's building, everybody who's applied, who's canceled, who's coming, right? And then, of course, we do our boots on the ground research, where we go knock on doors and go to the city and ask them, like, oh, hey, is anybody else? Oh yeah, John, he was over here last week. That doesn't show up in show up on record, but the intent. And then you go talk to John and you say, hey, you really going to do this? Because we're thinking about doing it too. And we've got into situations like that, and either we've given up or they give up or whatever, and we just move on to a different market if the market can't supply all that additional storage. So.
Does the self-storage purchases involves stringent requirement or stringent terms like what multifamily is, like day one hard money, very tight inspection due diligence process?
It's extremely competitive, and it might be as competitive or more competitive as multifamily.
Okay.
Because when people think of storage, they're like, oh, I've never really heard of that. I don't know what that is. And then they're like, and then they do multifamily and they're like, multifamily is really hard. There's all these people doing it. And oh my God, there's so much competition. Maybe I'll go try storage because it'll be less competitive. And then they go over to storage and they're like, oh, there's a lot of people that do this. But what the difference is, there are so many multifamily properties in the United States. Self-storage, you can't even hold a candle to the wind. I mean, there's 50,000 facilities total in the entire United States. Yeah. So when you're talking about competition, If you're looking at a property that's $1 million or less, no problem. You can go bid on it as a mom and pop. When you go $1 million to $1 million to 5, maybe 6 million, that you can reposition or that shows some signs of mom and pop operations, you're competing against the best of them. The all cash, the close in 30 days, 60 days, whatever it might be. But generally, what we do is we do about 10% earnest money deposit, and we will do, not 10%. We'll do like, on a $6 million facility, we might put up anywhere from 25 to 50K.
Okay.
And that doesn't go hard until due diligence is completed and signed off on.
Oh, okay. So that's not bad. It's not like day one hard money, like what's happening in multifamily, right?
No, we don't. And if we were in that space, we wouldn't play that game. You're just, whether you think it or not, you're competing with yourself at that point. You're worried about losing that money. I mean, we have 100% contract to close ratio. So everything that we've put under contract, we've purchased. I mean, we had a bank pull out 3 days before closing. We went and raised a private loan. We did our own deal. So we've done everything, to really help get the deal closed, and we've got that reputation to close. And I think that people value our relationship a lot more than they do necessarily how much earnest money we put up. So we've had a broker bring us a lot of deals, and just keeps bringing us deals because we make it real simple on them. It's a very simple process with us. We get everything on the table. We're very transparent. And as you know, in multifamily, that'll go a long way. Any business, right?
Yeah, so. That's true. Yeah, I mean, brokers people are easy to deal with, right? Because this is just multi-million-dollar deals, and you do not want to have a tough person to work with when you're going through such a big transaction, right? So, So at very high level, what are the value add that you usually do in self-storage?
Cameras for security.
Mm-hmm.
Rental rate increases.
So what you put a camera, you get higher rental rate, or it's just
people walk in and they want to feel secure. So our target customer is a 70-year-old woman. Mm. That's who rents our properties. So when they walk to your property, is it dark? Are there cameras? Is it secure? Does it feel like the fence is going to fall over? So we take the properties, we'll put in a new fence, we'll put in new cameras, we'll paint all the doors, we'll replace doors, we'll rehab the office. We'll put in notary services. We'll put in ice and vending machines. We'll put in...
Why do you need a notary service in a self-storage facility?
Convenience. So we like to be a shop of convenience. So if somebody's got an Etsy, Amazon, they have a home-based business, and they can come to our storage facility. They can drop their FedEx, UPS deliveries off at one of our properties. They can get their items notarized. They can ship. They can store. We even have a car wash at one of our properties. So, we try to be a place of convenience for people, so that not that we're going to make any money on it. It's just a place where people can go and know that they can get, I can rent my U-Haul truck to move my goods somewhere at your property. I can notarize my documents. I can store my belongings. I can do a lot of different things to transact and do my business obligations. And so we try to be kind of a helpful facility. Not every facility does that because not every facility even has an office. But the ones that do, we sell retail. We start, people pay cash. We get rid of cash payments and we go to as much automated payments as possible. We enforce the lease. A lot of these facilities we take over, tenants might not even be on adequate leases. So without being on an adequate lease, you don't have an adequate lien against their belongings. You can't do an auction. So
have you guys done auctions?
Oh, all the time.
Oh, all the time. Okay.
Yeah, all the time.
It's like the storage war in the TV, right?
Yeah.
That really happens?
Yeah. The semantics are true, or the actual process is true. But the way that it's carried out is not true. So nobody goes in person. There's some old school places that still kind of do that, but we do them all online. So you could go to selfstorageauctions.net. You could register, and then in your neighborhood, there could be a storage auction and you get alerted like, oh, hey, this unit's going up for auction. You could kind of log into your account and see, oh, what's in there.
All right. I can see all our audience and listeners are doing that right now.
Yeah.
I didn't even know that. What was the website? Self-storage auction?
I think it's selfstorageauctions.net.
All right.
And so as a company, what we do is we say, the storage auctions, they're revenue producing or whatever. They're not really revenue producing. They're basically just get out and get a new customer in. Like we clear out and it's the threat of losing your stuff, right? If you don't pay, you lose your stuff.
It's like an eviction process, I guess, right?
Right.
Except the government can't put the moratorium like what they did in multifamily right now.
Nope. The government didn't touch us. So usually within 30 to 60 days, so let's say, your rent's due today. If you haven't paid in 5 days, you get a late fee and your unit gets locked automatically. So the gate code that lets you into our properties, it will the revenue management system will automatically turn the gate off.
Really?
Yeah.
Say that again.
We overlock your unit. You can't even get into your unit.
Day zero, you don't pay your rent, and after 5 days, it locks by itself.
Just like that.
Wow.
And then we'll overlock you. So we'll put a red lock on your unit as well. Some of our properties will have the smart locks where it'll lock behind the door, so you can't get in. You can't get into your stuff. So if you don't pay after 5 days, you're automatically locked out. So we like that. We don't have to really manage that too hard. I mean, there's we have property managers or on-site staff that deal with that, but the gate code that's automatic. And then once you pay, it'll let you back in. But if you don't pay, you're locked out. So now you don't have access to your stuff. And after 30 days, we do our notices, our lien notices, and then we can take pictures of your property, do our publications, and then it goes on this website, and then people can buy your stuff. And then any earned income from that auction goes directly to us first to recoup the costs of whatever the tenant owed us, and then any cost of legal fees associated with it. And then anything that's left over after all of our money has been recouped goes to the tenant, because they got to be compensated for their stuff. So we get paid first, but most importantly, we get our unit back. And in multifamily or residential, they might trash the place, right? They might, they're going to do whatever they do, right? In storage, I mean, you can try to trash the place, but I mean, it's a box.
It's a box,
right? And, we just sweep it out, they move their stuff out, and they're gone. And then, for us, we just get our unit back. And, we let our customers know when they book, hey, sign up for our online auctions, so they can bid on stuff, and they can also know that, hey, we do online auctions.
That's so crazy.
So a lot of places we take over, I mean, the delinquencies are a mess when we take over, and that's a way to increase value, right? So we might take over we took over a property last year, for example, and I just heard from our management that auctions were there was people that were 180 days delinquent, and the manager just wasn't collecting on the units. He just wasn't enforcing the rules. So we'll come in and we'll just follow the rules. Your lease says this. If you don't pay with this, you go to auction. And then we make money on late fees. And some facilities that we take over don't charge late fees. I mean, if you don't pay on time, you should get charged a late fee. So there's a lot of different things we can do. And plus we'll repaint, we'll redo the doors. Some doors are the old cabinet doors. To open up the storage locker, we'll put the roll up doors on them. We'll improve the lighting. We'll redo the asphalt. Whatever it might be, we just get it nicer so that the customer feels safe and secure, and they feel like they're getting good value for their money. Got it.
All right, Ryan, why not you tell our audience on how to get hold of you and your company?
Yeah, sure. So my email is Ryan, RYAN, at Spartan-investors.com, or our website is Spartan-investors.com.
Awesome. Thanks for coming in and adding tons of value to our listeners and audience. Thank you.
Yeah, you're welcome. It was nice meeting you.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.